And we're live and we're back. Welcome to Mr. Raw's Raw Talks. I'm Stefan Everson as usual, and today I brought a special guest, in my opinion. Please welcome Ivan Hu. Not Ivan Ho, but Ivan Hu. And we're going to talk about financial planning and stuff like that, being a founder of a startup, whether you're in pre-seed or you already exceeded the pre-seed and going towards the seed, and talk about the importance of such things as figures and Excel sheets and all these shebang things. So nice to meet you, Ivan.
Hi, Stefan. Nice to meet you too, and great to be here. Thanks for having me.
Of course. And like me, as anyone else listening to this podcast, before we even continue, what's with your name? Because every British guy would say, hey, that's Ivanhoe. But in some new particular kind of way. So what happened there? Can you tell me a little about it yourself?
I like that you actually noticed that because not every British people I met actually know about the origin of this name, really.
Really?
You're one of the few who knows it. And I've got to thank my father for this. He is English educated. He couldn't speak Mandarin before he met my mom. So he gave me an English name. It's just natural. And he knows the story, Ivan Hu, Ivan Ho. So it's just natural, Ivan Hu.
Amazing. So you are based in England. Where are you from?
I'm based in the UK, in Exeter, Southwest. So for those who don't know the geography of the UK, you know the Cornwall is right at the southwest.
Yeah.
Famous for its beach, surfing, and fish and chips. Devon is the next best thing. It's just next to it.
Nice. And what do you do?
I work in startup finance. In short, for the last 10 years, I've worked in startups in various roles. As an investment analyst, and then subsequently 7 years ago, I joined a startup as a CFO. Grew the company, raised 2 million, and after 2 years, I left the business. I still advise the company, but now I've become portfolio CFO. I help numerous companies across different sectors, mostly pre-seed to seed stage.
Okay, so you both help pre-seed companies, people who are raising for the pre-seed and also for the seed.
Yes.
Right, and you specialize in financial planning, I would assume, being CFO kind of type. And
well, yeah. Sorry, carry on.
Yeah, no worries. And I know that a lot of founders are a little afraid of this part of the journey. Many perhaps don't even understand the importance of it. So why is it so important, this financial planning?
It's very interesting about the question, the way you position it. They are afraid of approaching finance. I think a lot of the fear comes from not knowing what they don't know. The first time they come across the term financial model might be because they are about to raise funds. So they go to the accountant and say, my investor told me I need to have a financial plan. Can you build something? Now, the accountant then pull together some numbers, which may or may not have much logic, but they'll apply a percentage year of year growth. So they'll say, I'm going to grow 30% year on year, 40% year on year. But that doesn't mean anything. So when they look at it and they say, well, I don't understand this, how am I going to present to investors? That's where the fear kicks in. They don't know. They just simply don't have the enough support they need to have a eloquent conversation with the investors. So that's where I come in. I work on both sides. I work from the investor's perspective. I've supported founder as a CFO, raise the funding. So a lot of my work is not just helping them build a spreadsheet they could present to the investors, but to guide them to understand, what do these numbers mean? When I say, what's your LTV CAC, what do they really imply? What's unit economics? Why is it so important to the investors?
Lifetime value.
Exactly. Lifetime value. CAC is customer acquisition cost.
Yeah.
It is a hot topic, especially in the last couple of years after COVID, when a lot of startups raise that sky high valuation, but haven't got the unit economics to back them up.
Yeah, because I've helped I've helped many founders as well alongside that journey. I don't consult much on the financial planning, but the past year, actually, I didn't. I only have two clients now whom I help with fundraising. I have three clients who are fundraising consultants because something crazy has happened in the past 1.5 years. Struggling actually finding somebody who has cash. Are you experiencing the same?
It's interesting because I went through ups and downs. I started in 2019 when we just about to go into COVID, right? So when I started helping a startup, the moment they launched the business, lockdown starts, right? So, and we happen to be in the meat business that supplies to hospitality venues, sell the meats online. So obviously, because all the restaurants are closed, that's how the business just gone overnight, right? Nothing is open, you can't supply the meat. But at the same time, we were lucky as well. We spent months preparing a online shop to sell meat directly to the consumers. And if you recall what happened during the COVID time, we can't get enough meat or groceries from any supermarkets, right? Everything just gone off the shelf. So on the week that we launched, lockdown happens. We sold 90,000 pounds worth of meat within a month without spending a dime in marketing. You know, so I know it sounds bad, but it was the best time for
That's a
that
lucky
business.
product market fit. Wow.
Exactly. So as you can imagine, the company grew rapidly. We then raised a substantial amounts of money for the stage where we were at because we grew so rapidly, and then things changed. Right, the lockdown lifted, so other businesses that were growing rapidly slowed down. The VC money hurts as well; they start to tie in. It was around that time I started to become a portfolio CFO as well, looking after other businesses. And the trend I see during that time is that the transition from my business is growing, I need to raise funds, to become, oh, I can't raise funds, and I know this is not the best time to raise money. I need to conserve my cash. How do I do that? So I still do quite a lot of work as a CFO, as an advisor at the time, and I still build financial models as a project for startups. But the focus turned into how to prepare your runway, how to control your costs, how to do with what you have, get through this period, or better, pivot. In some of the business I work with, we pivoted entirely from certain field into another segment because the environment has changed. Business shouldn't stay still. So in 2023, that's what I experienced. And then 2024, things start to look positive again. We talk about fundraising. A couple of my companies have raised funds from angel investors, VCs as well. So yeah, I'm feeling more optimistic this year. Fingers crossed for all the startup founders out there.
Yeah. No, and it's funny about pivoting because I think what most people, founders, don't realize is that they will first gain actual success when they pivot. That's more from the commercial side because, well, once you always begin with a dream, I'm going to do this, I'm going to achieve this. And then they begin and then they find out, wow, people really don't agree with me.
And that's a good thing, isn't it?
Yeah, or the market pivots, the market changes like your COVID case, and you need to pivot. But the point is, as soon as you pivot, meaning as soon as you understand your market, as soon as you have talked to your market, as soon as you have analyzed your market, and you start focusing on what really matters towards your market, you gain traction. It's crazy, isn't it?
Exactly. I think you hit the nail on the head, right? For any founder to say, go out of the door and say, this my business model is going to work, it never happens like that. So the moment you actually realize things that don't work and you change your plan, whether it's a big pivot entirely or small pivots, like changing your pricing, changing the product offerings, it means that you've learned something from the markets. You are actually listening and improve your business. Take that business, for example, we focus on B2B back then. COVID hits, we had B2C growing rapidly, and we raised money for B2C. Investors want to continue to see growth. But then the environment changed again. If we had stayed still and continued to put all the money into B2C, then today that company wouldn't have existed. But because we made a hard choice to re-pivot again, even though some investors thought we were crazy, we actually grew the company 4 times revenue since then, right? While a lot of our competitors that stuck to B2C, maybe because they can't change, maybe because their investors didn't allow them to change, they didn't feel that they could pivot, some of them have disappeared.
Okay.
And that's the nature of business. You got to listen to what the market tells you.
Yeah, I completely agree. This is what I'm all about. Listen to your market, talk to your customers. Please talk to your customers because they understand why you are who you are and what you can achieve with them. Yeah. Okay, so let's say I'm a startup dude, which I am. I unfortunately have a lot of experience, so I know. But let's say I'm a green young one who thinks we're talking pre-seed. What do I do? What are the steps I need to go through? And when does the financial planning actually come into financial modeling come into that framework?
So
what would happen? I would like to buy from you because I don't know anything about it. Please help me. What do I do?
Yeah. Sorry, I just want to rephrase the question. Are you asking as a founder?
Yes, as a founder. I'm a founder.
As a founder. Okay. So as a founder, the chances are you're going to think about financial model only when you want to raise funds.
Okay.
But financial model is more than just that. It goes into your day-to-day operation as well. Take, for example, you may have already done some financial planning yourself. If you are thinking about how to set the price for your product, you know, what's the cost? You want to calculate what's the margin. You start to put together some numbers and you say, I want to get 70% margin. This should be my price. But if I add shippings across, etc., what my margin is going to drop down to. So you have the gross margin 2 or gross margin 3 once you start putting sales and marketing costs. So you look at your real contribution from that product. Those are financial planning already at a small scale, right? And that's essentially what I do. When you speak to investors about your business model, you talk about different customer segment, different revenue model as well. Things can become complicated. You can understand on a high level how the business is going to be, but all the numbers mingle together and it affecting each other. You can spend hours, but if I build a model, solidly built model, investors can take a look at that, spend just 10 minutes digesting the model on themselves. They can understand what you're trying to tell them in an hour. So that's what the financial model is.
Yeah, and I would even go further because one thing is, of course, creating a pitch deck and the outreach to investors and stuff like that. But when you actually get in contact with an investor and you pitch them and they like the idea, the next stage for most of them is to look at the crazy big Excel sheet. That to me, I've always seen that is the actual due diligence on this stage. You check out the founders and then you check out if they actually know how to calculate, meaning they understand their journey going forward. And that's what I, at least from a personal perspective, that's what I use the financial modeling for, because what is happening? When is it happening? And if I can prove, that's why I believe I achieved to raise funds so many times is actually because I produced a crazy mother F Excel spreadsheet that the investment managers and partners just like to dig in, because that gives them the confidence. But also well knowing that not everyone is an economist or a financial advisor. So it's actually the few people I've seen who can achieve such a thing to make the actual model. I have a question though, because
Please do.
when I do financial modeling, it's more on the revenue side that makes it, stretching.
But that's the fun bits, right? The exciting bits. We want to see where the money is. Show me the money.
But when we look at the fixed costs of running a company, do you have any standard, thumbnails on what to do? I used to, for instance, always state that the co-founder should get 5,000 euros in salaries. Has that changed, or how do you actually set? Because when you have set the fixed costs, they're not allowed to be too high, but if they're too low, then it becomes also hard to believe, because even the investors know that you need to live somehow, especially if you have kids and shit.
Fair point. Yes.
So taking the fixed costs into consideration, how do you build that? Because that's a little quickie in regards to if a founder wants to get started, because when you get the fixed cost, that's what the reality needs to be sustained. And then you have the hopes and the glories of when the revenues explode and what it's going to be with that. And because it's always, you look at the fixed costs or the actual running costs, and then look at what will happen if the revenue actually does what it's supposed to do. What if it goes over? What if it goes under? What happens to the runway? So how do you calculate the fixed cost for a pre-seed? Because it's very different from a seed, obviously.
There's quite a few questions within the question you just raised, so I'm going to try to address them one at a time. Right? So the first point you talk about, spending a lot of time on revenue modeling, because that's exciting. It's true, right? Investors, if you got through the first stage, pitching, they get excited, they start looking into your financial model. It's because they want to see how does that stack up against what the vision that you painted to them.
Yes.
If you were painting this as a potential unicorn, but your financial model, revenue model shows that you are only hitting £20 million, £30 million revenue in year 5, it doesn't quite stack as a narrative, right? So that's part of the due diligence as well. Is the model that you presented, which is part of your narrative, consistent with the verbal communication you just told me? Right? Is it consistent? So that's on the revenue side. Now, on the cost side, it is less exciting. It is boring. But I would argue that it is perhaps the most, it is the center of focus for a lot of the investors, especially at pre-seed stage. Because the cost, for sure is going to happen, whereas revenue, it might not happen, or not happen the way the founders intended.
Actually, it never happens as you prescribe. I don't think that ever happens.
Yes, and that itself can be a huge topic for the entire podcast, and we can reserve for another day. But just on this point, the cost we know is going to happen because you got the people you want to pay a salary for, the investment perhaps in toolings, in certain capex equipment, that it's going to happen. Otherwise, you can start a business. So we know the cost is going to be there, right? So what that cost is going to look like, therefore, become a very important question. And will the money that you want to raise in the UK pre-seed is about 250k on average?
That's a typical angel round in England.
Yes.
Because of EIS, SCIS.
Exactly. It used to be SEIS is 50k, so pre-seed angel round used to be 150k, but today SEIS has become 50k, so 250k is the typical round. So as an investor, you can imagine, right? The founder comes to you and say, I need this money. Okay, I'm going to grow the business such. This is my model. I'll look at the revenue. That's the exciting bit. I'll be able to understand the business model from your model, which is great. But now the big question I want to know is, how much are you spending in the next 12 months or 18 months? Can 2K give you enough runway? Now, if you recall right at the start of our discussions, right, seldom a business goes out and straight away say, I've got the product market fit. They have some hypothesis, this is my product, they test the market and realize the market just responded in a totally different way. So you have to pivot. And to pivot, you need time, you need resources. And time here is the key thing. If you raise 250k and that gives you 12 months runway, it means that you have very little room for errors. Invest in some things, you start the business, you go out to test the market. By the time you complete that experiment and you say, oh gosh, I need to change, it may be at the end of your runway. And if that happens...
It usually is.
It usually is. And when that happens, it sucks because you run out of cash, you go back to the same investor will say, oh, I do not have confidence in your ability. It's either you haven't grasped the importance of that runway, or you have terrible execution and you're now coming to me for more money when previously you say you're going to be growing to this level and this level. So if you go to existing shareholder, that's what they would think. But if you go to new investors, sorry, if you raise without cash in the bank, you're not going to see angels. You're going to see sharks. And this is what happened in 2023, right? When a lot of companies had to do bridge round, and you see a drop in valuation.
Yeah.
And that valuation is, I would say, lower than what the business should be, to reflect that the management team has made some errors, right? So you start to
But
see
that's
some...
because the switch you have. I've been a founder for Jesus Christ 28 years now. The whole market has shifted a lot, because up until 23, the scarce resource for many years was the actual startups. But suddenly, the scarce resource became the money.
Yes, it is that as well.
And it still is, by the way.
It still is. But like I said, I'm slightly more optimistic this year. So
You have
fingers
to be
crossed.
optimistic.
We all are. We all are. Otherwise, let's get a job,
Yeah,
isn't it?
exactly.
So I would say that swing of expectation in 2023 is more than just a reflection of the fair value of the company. It's a swing from overly optimistic about the value of a business to a very pessimistic view of the business, right? So that swing wasn't doing any good to the company, but some companies had to do what they have to do. They race, they survive, and if they manage to get through it, then there's still hope, right? So back to the earlier point we were discussing, runway. That's a very important point of discussion between investors and the founders at this early stage. It's fine talking about revenue. You should show the ambition, how you want to scale,
Yes.
and how that scaling is going to impact and what kind of resources you need. But the real test is on the expenses. As for the founder salary, it is tough, right? I had quite a few conversations, and in fact on LinkedIn we made a few posts, debate this publicly. What should be the fair salary for a CEO?
Yeah.
I would say it depends. It depends on whether you are
That doesn't
pre-seed.
help, does it, Ivan?
I know it doesn't, but like all things in life, it's not about whether it helps or not. It's about knowing what happens in reality. If the answer is it depends, let's listen and look at all the factors, and you then come up with some kind of a proposal that can be acceptable to investors. So we can outline the factors that you mentioned before. Have you got kids? Have you got a family? Are you living in London? That changed the perception compared to somebody like 22-year-old living somewhere in Europe, traveling as a digital nomad.
Living at home.
Or living at home with family. I know it's not fair. I know it's not fair because that founder doesn't necessarily mean that has less worth than another founder with kids, right? But I think they need to wear a different hat in here, a pre-seed to seed at least, right? This is still your company. You are the king, you are the owner. And the moment you start to wear the hat of an owner, you then look at the resources. I've now raised 250K. Should I pay 100K to myself, leaving 150K just to run the business? Or should I pay myself the bare minimum so I have most resources kept in the business to grow the business? Because I know by doing so, the chances of me going to the next stage of growth and raising money at a higher valuation will be much greater. So it comes back to the question, do you want the money today or you want the money in the future? Because if you believe that you can grow the company, that the money in the future will be far greater. I know what I would choose if I really believe my company.
That's how the investor also looks at it.
Exactly. So once you know those factors, you should be able to come up with some numbers, right? And by the end of the day, you still have to have a roof over your head. You need to feed your family. So come up with a number, a sensible number, and then have a healthy conversation with the investors. That's what I would propose.
Yeah, makes sense. So you have founder costs, you have employee costs. What other costs do you usually put into the fixed cost part of it?
If it depends what sort of business you are in. If you are totally online, digital, rent is much lower compared to, let's say, you run a physical site. Then you start to have rents, power utility bills, etc., which can scale as when you scale to multiple sites, right? Especially in the last few years, the energy bill has become hefty. That's
Jesus
quite a big
Christ.
chunk. I know, I know. Imagine running a hospitality business is not great. And so that could be a big part of the cost. But I would say also costs associated to fundraising. When you raise funds, it's unlikely you're going to not spend a single cent on fundraising. You need advisors, you need like us, you need a legal document put together by lawyers, which
There's
won't come
always
cheap.
5, 10K out in the drain, down the drain.
Yeah. And if you need to set up EMI options pool, that's another 5 to 10K as well, right? SEIS, EIS application in the UK especially, you can do it yourself. But if you find an accountant or lawyer to do it, that costs money. What else? If you go to a broker to introduce you to investors, they charge 3 to 5%. That's the money gone. So that is a big part of the cost that you have to build into the planning. If you raise 250K, how much do you spend on fundraising? Other than that, I'll say most of the cost will come from cost of sales. Overheads will be, like we discussed, payroll, founder salary, engineers, marketeers, salesperson. Having seen over hundreds of financial models built by the founders before they come to me, I noticed one big mistake they make is to undercount the spending they have to do on payroll. Because most people could intuitive know the kind of people they want to hire in the next 6 months or 12 months. They say, I need to have 2 engineers back end, I need to have 1 front end, I need to have a UX UI designer, and
And people
probably
always forget the Q&A, by the way, the QA, the quality assurance.
Q&A. Yeah, that's a good point. And then they know they have to hire a marketeer or somebody doing sales, commercial person, and the planning stops after a year. And they remain the same headcounts. Perhaps some pay rise, they'll say, okay, I do proper calculation. Let's assume everyone get 5% pay rise. But they totally forgotten to add more headcounts in year 2, into year 5, whereas their revenue just keep climbing up and up. And usually what I do when I audit a financial model, I look at the revenue line and I look at the salary, wages, and the headcounts.
Mm.
A benchmark I like to use, and this is a quick tip for your audience here. On average, startups employee do a revenue generation of about 250 to 3K per employee. So for example, if you have 10 million revenue, and if each employee is doing 500K revenue, you need to have how many? Gosh, I can't do maths this morning. Did we say 1 million revenue or 10 million revenue?
That's up to you.
Let's say 1 million revenue, right? So you need to have 20 employees, so on and so forth. If you're 10 mil, you need to have 200 employees to hit that sort of traction. Because it is very rare for startups or any companies to achieve high efficiency of revenue earned
Impossible
per employee.
to achieve. It's simply impossible to achieve high efficiency when you are growing. It's
Yeah, exactly.
it's the other way around. It's a whole different type of managing and operating a company when you go into to looking at the efficiency, not looking at the growth. So I agree. I totally agree.
Exactly. And I think only the oil and gas industry or Apple, the big tech company, were able to achieve like 1 to 2 million revenue per employee, right?
Mm-hmm.
So if you see your financial model shows the headcount of revenue per headcount going above 500K, I'll say let's put in some headcounts
Mm-hmm.
to make it more realistic.
I would actually say that goes for everything but cybersecurity. I was in Israel for 3 months last year, and I met this cybersecurity company. I helped with traction, I helped with growth and stuff like that, and we had a great meeting. This guy, this founder, and we just clicked, and I exactly asked about that particular point. There were 6 employees. and their annual revenue was $72 million.
Gosh,
Like, whoa!
gosh.
I can't help you.
Where's the company now today?
Well, it's one of those companies you never hear about,
Yeah.
but they're striving. Let's just put it that way.
Well, I can't imagine otherwise. Gosh, that's
But
a great
actually,
business.
no, because they were raising their Series B at that point. Luckily, I gave him a good advice in regards to it because he was trying to reach out to people, and that would be wrong in a case where you make so much money on each employee. So I encouraged him, and yet he did change the whole scheme that he started using marketing so the investors would start bumping him instead of him reaching out, because then you're standing in a total other situation, which is the preferable situation for everyone trying to raise money, is that you have 10, 20, 30 people saying, please, can take my money, take my money. It's a very rare situation as well, but at least that happened to those guys.
It happens for certain sectors. That's a great business you just described. But also, I think as we get into this AI generation, we're going to see a fundamental shift. The efficiency I just described there, the revenue per employee, was obviously based on the previous data. And if you look at the new way of running a business, you see news about company raising funds. I think yesterday somebody posted about Baldy, a AI company that runs the entire funding round without talking to the founders. The AI do the conversation with the investors, the due diligence, answer every questions, and the investor just went to the data room chatting to the AI to get what they want to understand about Baldy, and they sign a check just like that based on that conversation with AI. Obviously, that's an AI company, right? So doing that test is very critical. But even beyond that, I can really see the impact to other startups. Take YC Combinator, for example. I think the founder of YC disclosed that one of their portfolio company saw a reduction of the customer support resources they need by just using AI. Things are answered faster, they need lower headcounts, lower resources, and they managed to become cash flow positive within 12 months. Whereas in the past, it's unheard of, right? So I think that is going to change over time as we see AI implementation startups into enterprises. The efficiency is going to be better and better. You're going to see more cases like that. 7 founding team and then doing like hundreds of millions of revenue.
Yeah, I think what's going to have the greatest impact on most companies is the AI controller function in a company, because that can remove all the fat.
Yes.
That's quite interesting.
Just one person using AI, doing prompts and setting the gate, what data goes in, goes out. I can see that role happening, being critical in businesses.
So is it even possible to raise funds not having AI in your company right now?
That seems to be the trend. But even if you don't have the AI, don't feel disappointed, right? There are still found businesses out there raising money without mentioning of AI. I would say that this kind of phase comes in and out. Every year we have this. Previously we had Web3, we had Meta. There was a time, and then crypto. That's gone. Now it's AI. So that's going to be always the next best big thing. And it's very important for the founders to know the opportunity. You rise with the wave, but at the same time, don't do it for the sake of riding the wave.
No, I've seen so many times, where helping startup founders, and you ask, why do you put AI in? And they say it's because that's what all the investors want to talk about. So we have to put some AI into to our engine. Otherwise, they don't find it sexy to talk about.
Which is a strange thing, right? Because a few years ago, I helped a startup, and I remember they speak a lot about this blockchain they want to introduce, which costs a lot of money to implement. But if you look at the business model, it doesn't make sense. They don't require blockchain to distribute the whatever they want to distribute to their consumers. All they need is just a simple database. Yeah, a simple database. Do the job, get it done, and focus on driving sales, marketing, and bringing customers in. You don't need to spend months and raise money to build this blockchain, while at the same time holding off your marketing proud because you are waiting for this big team to come up. It doesn't make sense, right? Introducing technology has to make sense. Same with AI as well. If it doesn't make sense to your business, why?
So what's the difference between financial planning if you take pre-seed and then you look at seed?
Pre-seed is, in many ways, I would say, like painting on a piece of white paper.
Yeah, or pulling something out of your. I'm not allowed to say that, I guess. Well, that's the usual thing. I say this is how you find your valuation as a pre-seed. You take your hand, you go in, and that's also in reality the rule. You take your cost base for 12, 18 months, and then you double it because you know things will not go that way. And then you have some cost base, and then you multiply it with 5, and then you have your valuation.
Yeah, in fact, that's a parallel to what a VC once told me many years ago when I was very young, new to my job. I asked this VC, I say, how do you review the financial model when somebody presented it to you? He said, very easy. I simply half the revenue forecast and I double the expenses. Yeah, exactly what you just said. Back to painting. It really is, right? If you are pre-seed, you don't have much data to go on. You have done some research, which is very important because I'm going to use this research as a basis to help you build the assumptions. And we always build assumptions bottom up, right? So it's not just saying, oh, I want to target 1 million revenue this year, 2 million next year, because that's 100% increase. That doesn't give any intelligence to conversation with investors at all. What are you going to say? Oh, I'm going to say my revenue will double to 2 million, and the investor say, no, you won't. How are you going to argue against that, right? So you always build assumptions bottom up. Who are your customers? How do you segment them? Is it by a large enterprise, medium scale up, and then small startups? How do they spend, right? Is it average MRR of X amount, £50 or £100? Or is it a more expensive product that costs £500 per month?
Yeah, and while we're at pre-seed now, you're talking about assumptions. I think the real change within the last couple of years is that the investor doesn't look at the assumption now. He wants to know, do people actually want to buy this? So going in and testing whether your assumption is right or wrong can only be done by one way, in my opinion. And that is to talking to the customers to find out, do they actually want to buy from you?
Yeah, exactly. The modeling, all the assumptions built up, shouldn't just pull out of nowhere. It should have been done because you have already spoken to a customer and you know that's the price they're going to pay. Now, it doesn't mean that all the customers within your segment are going to pay at that price, but at least I've got some basis to base on, right? And there's a reason why pre-seed is high risk for investors, because there's a lot of uncertainties. But as a founder, the more uncertainties you can reduce, the more likely you're going to raise funds at a valuation that you want, right? The more risk that you present to investors, because there's a lot more unknowns, then the valuation is not going to be great, or worse, you're never going to be able to raise the money, right? So that's pre-seed. You are trying to paint a picture on a piece of white paper, start from scratch. When you are at seed stage, things become more serious. Investors like to see PMF by then. Have you got a product that is not purchased by just one customer, but a lot of customers within that specific segment that you're targeting? And if you can achieve that, has it come to a point where you just pull a certain lever, let's say increase sales, increase marketing, and you can see a factor of increase in those customer acquired? And if there's customer churn, is there something you can lever that you can pull to reduce those churn as well? And if you can do that, then we can put that into a projection and look at how the revenue, the margin is going to grow over time. That's what I call seed stage. You have some data, and you've reached a certain stage in the business, PMF, that gives confidence to investors to start pouring in a lot more money.
PMF is product market fit.
Product market fit, yeah. To help you scale. So seed stage and pre-seed, I would say that's the major difference. And when it comes to modeling...
And it's funny, if we had this conversation 4 years ago, what you're talking about would be the Series A round. But the Series A round is considered by most investors as a seed now. So there's so much more reliant on the founders to achieve before they can actually get the money. It's like it's just been skewed one stage going back, which is quite unfortunate, but a reality.
Well, a quick answer to that is FOMO, fear of missing out, isn't it? If we look at the data for the last decade, 2020 to 2022 is really an anomaly. We had the most funding raise, the highest valuation ever. The number of rounds that went through is highest than any other years that we've seen.
Yeah, and exit.
Beyond anything we've seen. Exactly. And the number of bridge rounds subsequently happened in 2023. So that really is an anomaly. And today, I think we are just back to what it was and how it should.
That's nice to know. That's probably the most important thing to understand. Okay.
Exactly.
So how should a founder go forward in regards to finding what should he literally be doing? It's not about marketing you, but it's like in general, if I'm a founder, what do I do? I find somebody who can do it for me, or do I learn it myself? Or what do I do? Do I go to Ernst & Young?
No, well, with all due respect, Ernst & Young, BDO, they are highly capable, but they are not the right fit for startups.
No. And I would like to say an accountant can't do financial modeling.
No. With all due respect, no, they can't. Not financial planning. They can do your accounts. That's what they are trained to do and what they are very good at. I'll never get into that area myself. But accounting is different from finance. This is supposed to be a financial model podcast, right? But if everyone could notice that we speak a lot more than just financial model. It's more than just spreadsheet. It relates to funding, understanding of the fundraising, and understanding of what the investors are looking for, and understanding of the business strategy. So that's finance. That's not accounting. And that's what set them apart, right? You don't get accountant to do the job of financial planning because it's a different part of the world. It's a different world, really. So how should a founder find somebody to help them with financial planning, or should they build their own financial model? That's a very good question. About 12, 13 years ago, when I was running a biotech company backed by a VC.
Martech, is that marketing or is that maritime?
Sorry,
did you say Martech?
Oh, no, biotech.
Oh, biotech. Sorry.
Yes.
That's a whole other game, by the way.
It is a whole different game, yes. I was trained as a scientist. I thought I was going to be a physicist, chemist, and straight out of uni, however, I joined a biotech company. And that was a VC-backed business. My role was on business management, running the team, build partnership, etc. And the VC say, Ivan, we need to start putting together a financial plan. Can you do that for our next board meeting? I say, yeah, not a problem. I have no idea how to do one. I've not done it before. So that weekend I went to a bookshop and I bought a book. And that book is still staying on my shelf, using that to remind me constantly what you can do. It's a book called Basic Financial Model for the Dummies. You know this book, Yellow, Rolling Stone, yeah. I read that over the weekend. I opened my laptop, I built a spreadsheet. It wasn't perfect, but it gets the job done. Financial model can be as simple as that. Put the numbers in, get the job done, show how the projection works. If you are willing to learn, and I would say that's the best way of doing it, learn it, understand the numbers yourself, and build a spreadsheet. But sometimes you need to be a bit more sophisticated. If I look at the model I built, some of the main issue is, of course, I didn't know how to do bottom-up analysis properly. I use quite a lot of year-on-year growth, which, as I explained, investors don't like that. The second thing is the structure of the model makes it very difficult for me to update the assumptions. So, some of the mistakes, like you build a input within a cell, you write the input within a formula. So the next time you want to change that input, you have no idea where you put them into the spreadsheet. It's hidden somewhere, and you have to toggle the cell, change the input. So imagine you get into a conversation with the investor, and the investor say, what if you didn't raise 2K, you raise K? how's that going to change your investment into marketing, etc.? Can we increase your sales target? You're going to go frantically around your spreadsheet and trying to find where went wrong, where your input is, right? So all of this is part of the discipline of building a financial model professionally, and that takes years of practice.
Yeah, it does.
And
Scenario
in that,
building.
it is a skill set. Yeah. So for that, you
A
should
geeky
find
skill set.
a geeky skill set, which I love. I'm a geek, right? I play games. I'm a photographer. I spend a lot of time with my computer, and I got this big 38-inch screen, which I'm very proud of. I can put a spreadsheet next to it and my assumptions and the webcam as well. I'm a geek, and you're hiring a geek, right, to do this work. So I'll say if you need help with financial model, don't look for accountant, but look for somebody who has done it before, who has built a model, raised money. That would be even better, right? And who is able to guide you as well. Have the patience to teach you. Because the last thing you want is somebody to build a model for you.
And you don't understand it. You can't explain it to the investor.
Yes, and that's bad form, isn't it? Because I always tell my founder, I'm going to teach you. I'm not going to just hand you over the spreadsheet. I want to teach you so that you own all the numbers at the end. I might help you to build the tools, but I want to put you in the driver's seat. Because I'm not going to be there when your investors ask you the question about your financial planning. You need to answer on the spot. I can join you in some meetings, but I'm never going to be there for you forever. If I'm doing all the pitching, then why is the investor investing in you rather than me?
Yes,
I must as well just run the business, right? So it's all about financial model planning. It's not just about building the spreadsheet, but also about learning.
Yeah, that's very important, actually. I totally agree. It's about very well. So yeah, that's good. So find a guy, make sure that he succeeded with what he's doing, because there are many fakes out there, just to be clear. There are many fakes out there who think they can do it. And we also need those guys, because we need some new guys who also are achieving something, but that's not your responsibility as a founder. Your founder is to make sure that you prosper with your project. And that is always by leaning on people who knows better than you, but it's not enough that they know better than you. They have to teach you what they know, because you have to know yourself as a founder.
Exactly.
Perfect. Ivan, it's been great talking to you. I'll, of course, leave a link to your profile if people want to talk to you about this, or just connect, because I see you put out some good content on LinkedIn in regards to financial planning and stuff like that with startups. So people should definitely follow you. I'm following you.
Thank you.
Hence why we even are talking, because you actually deliver great content, and I'm assuming it's not even AI content, it's actually real content.
Take me hours to write the content, but I enjoy doing it. I enjoy sharing. I enjoy teaching, right? I teach my founders, and for the time I'm not teaching founders, I'm not doing hiking or traveling or spending time with my wife, I write content and share on LinkedIn. So please do follow me. Feel free to engage with my content as well. I talk a lot about startups, the evaluation, about what it means to be a founder, but most importantly, I talk about financial planning. So feel free to follow me. Thanks, Stefan. It's been a pleasure and honor to be on this podcast with your audience, and thanks for having me.
You are all. Ladies and gentlemen, Ivan Hu.
Thank you, Stefan. Bye, guys.